Everyone who knows anything about the housing market has heard the chilling tales of the Great Recession, but most people haven't heard a thing about the Great Inflation, and we're at a huge risk of history repeating itself. Let's talk about it. Well, hello, I'm Wendy Pinnell, and I hope you're all ready to brace yourselves because the disaster of the 1970s is back in town. You always hear the talk about the Great Recession, you know, the whole housing crash of the 2008 and how things will be different this time, but what you don't hear is people talking about the Great Inflation. So while everyone out there is hoping that 2008 doesn't repeat itself, the likelihood is far greater that we're looking at another Great Inflation 1970s style. Now don't get me wrong, our current market does share a lot of similarities with 2008, but many of those similarities stem from different causes than what we saw in 2008. But when we compare the Great Inflation of the 1970s, we see a lot more potential for a copy and paste. So why is no one talking about the Great Inflation? Well, I think people simply don't know the history of interest rates. And unfortunately, not knowing the history lesson behind the 1970s Great Inflation isn't the only downfall to this. You see, how people view the history of interest rates really affects what risks people are willing to take today when they buy a house. For example, interest rates have been under 5% since 2009, so buyers are used to thinking, 3, 4, and 5% interest is totally normal. The general perception of the public is that we're in some extraordinary situation of super high interest rates, and once the economy calms down, things will go back to the normal rate of 4 and 5%. This makes people more comfortable to buy homes with risky mortgages because they know, or they think they know, that rates are going to return to normal. And again, by normal, they mean 4 to 5%. The problem is 4 to 5% isn't really normal. The truth of the matter is that between 1971 to 2009, interest rates had never been below 5%. If there was an average at all, it was more like between 7 and 9%. So it kind of sounds like where we are right now, right? Oh, and don't forget about 1981, when rates went up as high as 18.37%. You only thought that 7.5% was bad. So if you knew that 7.5% was actually on the low end of average for the last 50 years, would you really expect rates to go back to 4 or 5% any day now? Or would you maybe think it's better to buy with a fixed rate at 7% rather than risk a mortgage that could adjust up over time? I'll say it again, how you view interest rates will guide how much risk you're willing to take in a mortgage. Now, there are gonna be those in the real estate industry that are solely focused on getting paid, okay? And they're gonna say things like interest rates are only gonna go down from here, and my favorite, you can always refinance. And sure, it's possible, that we'll go down and those rates will go down and you can always refinance. But if we're looking at history, chances are that rates could also go up. Now, I get that not all of you are obsessed with real estate like I am, but it really is in your best interest to understand this. The more you can be informed, the more you can make better purchasing decisions. Now, that being said, the majority of buyers and sellers out there really don't know much about history, and as a result, there is a big push to use riskier mortgages. I mean, first off, we have ARM loans. Right? What is an ARM? You ask. Well, ARM stands for adjustable rate mortgages. The mortgage will adjust periodically, either up or down at specific periods of time. For example, they might adjust every year or every 6 months. In CNBC's article on how ARMs work, they share how an adjustable rate mortgage comes with a low introductory interest rate for a set period, and after the teaser rate expires, the loan's interest rate changes as mortgage rates shift. When interest rates are low, people don't usually use ARMs, but when rates go up, so do their popularity. People began using them because they can have a lower monthly payment and they can afford more house. CNBC reports that when rates went up in 2022, the share of ARM loan applications peaked at nearly 13%. So what do we have, 13 out of every 100 people who are banking on the fact that rates are going to come down and they can refinance. So why are these mortgages so risky? Well, it's in the very first word, okay? Adjustable. CNBC states the biggest downside to an ARM is that your monthly payment can increase And that's a risk you should be prepared for when the introductory period expires. And here's where our first point comes back into play. If you believe the only direction interest rates will go from here is down, an ARM loan doesn't sound all that risky. In fact, if all you've ever known are 4 and 5% interest rates, ARMs are kind of a no-brainer. All right, now just as an example, in 2004, we bought our third house, where we still are today, okay? We're talking total dream home status. We absolutely love it here. Anyway, we used an interest-only ARM. Our mortgage payment adjusted every 6 months, and we got lucky. We held that mortgage from 2004 until we refinanced in 2020, and the rate never went above 6.8%. But you want to talk about risky, okay? The way the mortgage worked was it was interest only for the first 10 years, then the entire balance was amortized over the remaining 20 years. I mean, imagine if we hadn't refinanced in 2020, our rate would be well over 8% right now. So we scored a 3.75% interest rate in 2020. The mortgage part of our house payment is $11.58 a month. Now, had we gotten too busy making videos, we just didn't get around to refinancing, our payment right now would be $2,091 a month. Okay, a full $933 more a month. Everyone in the, you can just refinance camp focuses on the rates going down. But again, you need to know that's not always what happens. Another type of not so safe loan is called a 2-1 buy down. Investopedia describes a 2-1 buy down like this. They say a 2-1 buy down is a type of financing that lowers the interest rate on a mortgage for the first 2 years before it rises to the regular permanent rate. They continue, the rate is typically 2 percentage points lower during the first year, 1 percentage point lower in the second year. So it sounds nice for the first 2 years, right? Well, a 2-1 buy down is different from an ARM in that it won't adjust forever. Okay, your permanent rate will be locked in when you buy it, and the first 2 years get you warmed up for it, so to speak. The real risk here is in overextending, because again, what does everybody say? Oh, you can always refinance. Again, if you believe 7% interest rates are this wild anomaly, you're really not going to see a risk with these loan programs. But here's the thing, the Fed won't necessarily lower rates from here, and honestly, maybe they shouldn't. Now, before you shoot the messenger, okay, you need to know what happened in 1970 when the Fed lowered rates too quickly. It was a disaster. Lori Walsh explains how it all began. She says that the comparison of the current economy with that of the 1970s is valid because an aggregate supply shock instigated each inflationary experience. In layman's terms, we had supply shortages in 2020, and we had them back in the 1970s. Walsh explains that in the 1970s, the Organization of Petroleum Producing Countries, and then later the Iranian Revolution, reduced the supply of oil to a U.S. economy then heavily dependent on foreign sources of petroleum. She continues, oil-producing countries cut the supply of oil prices rose, and broad-based inflation followed as firms raised prices to cover costs and workers demanded higher wages, leading to further price increases. Simply put, this means a shortage of oil due to an oil embargo. In other words, they wouldn't give the United States any oil. Now let's look at 2022. Sharp describes how in the recent run-up of inflation, an aggregate supply shock induced by COVID buffeted the U.S. economy. She continues, during both experiences, the outcome was a rise in inflation and a fall in output, followed thereafter by expansionary macroeconomic policies. All right, what were those expansionary policies? Well, the CARES Act and near zero interest rates. There are some real similarities between what happened in the 1970s and what happened during COVID. Sharp points out that both times, aggregate supply shocks instigated inflation by reducing the economy's ability to produce goods and services. In the 1970s, it was a political move, but this time around it was due to COVID. Sharp continues explaining, she says, during both the 1970s and COVID, policymakers responded to the bad luck of aggregate supply shocks with good intentions. Expansionary macroeconomic policies without knowing precisely the level of full employment. In other words, the reason the Fed slashed rates to zero is to keep the economy growing, even though we were in a massive supply shortage due to everything shutting down. That word expansionary. Okay, what that means is they're trying to make the economy grow. Now, think about the logic in this, all right? During COVID, everyone was shut down and not allowed to leave the house. But meanwhile, right, the government was mailing us all checks and providing cheap credit, right? They were like fueling the fire, like a boiling pot of water with a lid on it, right? They just kept begging us to keep spending money. As soon as we were allowed to leave the house, we were poised and ready to spend, and the economy exploded. The problem was there were still major supply shortages. So even though we wanted to buy everything in sight, there wasn't a whole lot in sight of what we wanted to buy. So, prices were driven further and further up. Oh, and here's a really good point. Sharp describes how inflation movements during the two periods are highly correlated. The correlation is 0.95. That means that when you overlay the inflation numbers in the 1970s and today, okay, there's a 0.95 similarity, all right? That's pretty dang high. Looking at the graph, you might think, well, I'm okay with that correlation. Look how fast inflation came down. But unfortunately, that's only part of the story. We need to explore the Fed stepping in both times and how the economy and inflation responded to the Fed's actions to really understand why we're at so much risk here. So we're in the 1970s, inflation's raging, and the Fed raises rates. They see the inflation, they know it's their job to slow it down. In order to do that, they have to switch to monetary tightening instead of expansionary. Jesper with Rangvid's blog describes how, as much as inflation was a problem in the 1970s, the Fed at least got the timing right back then. As soon as the blue inflation line went up, the orange line indicates how quickly the Fed began raising rates. Now let's compare that to how they did in modern day 2022. Right? It was handled completely differently this time around. As inflation began skyrocketing, the Fed held rates at zero. As Rangvid's blog explains, compare this to developments during the past few years. Despite the rise in inflation during 2020 and 2021, the Fed funds rate was kept at zero. When the Fed started raising rates in March of 2022, inflation was already running at a red-hot 8%. Jesper describes how two problems follow from this late reaction: the risk of monetary policy miscalibration and the risk of inflation becoming broad-based and difficult to combat. I mean, basically, the way the Fed has been trying to tighten money hasn't worked to the extent that they thought it would. I mean, we keep thinking inflation will make its way down to their 2% target, but instead, we saw it pop back up in the past few months. When we think the job market will soften, it comes out measuring stronger. The Fed allowed too much time without pulling the reins in, and now we have ourselves a broad-based inflation problem they haven't been able to contain. So what ended up happening after the Fed's quick reaction in raising interest rates and taming inflation in the 1970s? We need to see the rest of the story because it doesn't end well. Jesper explains how as soon as inflation started falling in the early 1970s, the Fed reduced the Fed funds rate. Now, this was a huge mistake on their part, and it's the same mistake the Fed risks making now. Inflation came roaring back with a vengeance, faster and higher and more difficult to contain than it had the first time. Like, it literally went up almost twice as high. In his article, Jesper has an urgent message. He says, this is a warning. The Fed needs to keep a steady hand on the tiller. Despite calls to reduce rates soon, the Fed needs to keep rates high enough for long enough. Now, I know that's not what anyone wants to hear. When it comes down to it, these higher interest rates we're seeing today, they may be the lesser of two evils. Jesper continues saying, the 1970s taught us that not doing so resembles a kick of the can down the road approach, and the subsequent price to pay becomes so much higher. So what was the ultimate repercussion back in the 1970s? Well, inflation became so severe that the Fed raised interest rates to 18.37% in 1981, resulting in 2 massive recessions and unemployment rates up to 10%. Now, there's a lot more to this story that I could tell here. For example, in the 1970s, both the government and the people were not nearly so laden in debt. The government had also just left the gold standard, and the economy was composed far more of manufacturing, unlike today where it's composed more of services. There are many reasons supporting the argument that we won't see that second vicious wave. But do you see the risk? I mean, the what ifs? If you see it, you know the Fed does too. It is dangerous to assume rates will be going down anytime soon. There are one of two eventualities. Either the Fed knows they need to keep those rates high, or the Fed lowers them too early and we risk a massive second wave. Either way, there's a lot of risk to adjustable rate mortgages and 2-1 buy downs that you just don't need to be taking. Well, now that I've given you a whole lot of bad news, let's talk about some potential alternatives to our situation here. If we know adjustable rate mortgages are a risk, what else can we do to get lower payments? Well, first of all, do not base your decision on the assumption that you can refinance, okay? Don't gamble on the future like that. Your best bet is to have the seller, regardless if it's a new construction builder or an individual, pay down your interest rate, okay? Now, but before you get too excited, there are some important things you need to know here. A payment of 1% of your mortgage amount will lower your interest rate by 1/4 of a point. In addition, loan types have limits as to how much a seller can help you with closing costs. With FHA, it's 6% of the mortgage. With a conventional loan, it's 3% of the mortgage if you have a 5% down payment. With conventional, it's 6% of the mortgage if you have a 10% down payment. So even if a seller is willing to pay towards lowering your rate, they can only lower it between 3/4 and 1.5% of your rate. Now, there is one loophole here, and it is awesome news, but only builders are offering it. And this is probably your very best option for a lower interest rate. It's through something called a forward commitment. Devin Bachman explains it this way. Some builders purchase forward commitments which provide tranches at below market rates to originate mortgages for their buyers as an alternative to buying down the rate. The key words there are as an alternative, and here's where the loophole is. These new construction lenders are able to offer these low fixed rates without it coming from the 6% cap. They can literally offer a 5% mortgage and pay a buyer's closing costs at the same time. Right here in Dallas, there are numerous builders offering these forward commitments. D.R. Horton is offering a 3.99% mortgage for the first year and a 4.99% mortgage for all the years after that. Starlight Homes is offering a 4.99% fixed rate mortgage. Centex is offering 5.25% fixed rate at certain communities. History Maker is offering a 4.99% fixed rate mortgage. First Texas Homes is offering a 5.875% fixed rate mortgage. Even Bloomfield has jumped into the fray, offering fixed interest rates in the 5s. Now remember, the way these forward commitments work is typically on specific communities. We here at Home in Dallas have an ever-evolving spreadsheet where we constantly monitor interest rate specials and where they apply. If you're interested in taking a look at that, check out our Let's Find Home questionnaire and we can get connected. Now, there is a whole other way you can get a low fixed rate mortgage even with today's interest rates, and that's with assumable mortgages. All right, most of today's FHA and VA mortgages are assumable, and a lot of them have those beautiful 3% interest rates. I made an entire video about assumable mortgages that you can watch right here. In the meantime, Wendy out.